Hi there, it's Friday the 2nd of August 2019. I'm Steve Towers. Welcome to ITB. Let's get started. As you know, one of the many uncertainties at the moment is the specific tax rate which will be used for the global minimum tax proposal under Pillar 2 of the Inclusive Frameworks Digitalisation Project. Maybe it was because he was in Ireland, but Pascal Saint-Amans said this week that he wouldn't be surprised if the specific tax rate was close to Ireland's 12.5% rate. And in regard to the conflict between France and the US concerning the French DST, the US, of course, has several fiscal responses available to it, from tariffs on French imports to a doubling of the US corporate income tax rate on French companies. But President Trump has hinted that tariffs on French wine imports might be the initial target. He said, "I've always liked American wines better than French wines, even though I don't drink wine." And later he added that he prefers the look of the American bottles. Unfortunately, the French agriculture minister responded by describing the idea as completely moronic and absurd. The China-US trade war has worsened. President Trump tweeted yesterday, "The US will start on September 1st putting a small additional tariff of 10% on the remaining $300 billion of goods and products coming from China into our country. This does not include the $250 billion already tariffed at 25%. And the Japan-Korea trade war has also worsened. Today, the Japanese cabinet approved a plan to remove Korea from Japan's so-called white list, 27 countries which receive preferential treatment on export approval on more than 1,000 items, including machine tools and electronic parts. This will require Japanese exporters to Korea to obtain licenses for a range of items. The Mauritius government has criticised the so-called Mauritius Leaks news story which broke last week, calling the allegations of a serious and malicious nature and factually incorrect. For a copy of a government statement on this topic, please go to our website or app. And the OECD's Global Forum on Tax Transparency has released 9 peer review reports on compliance with transparency and exchange of information standards. For a copy of the reports, please go to our website or app. In Australia, the full federal court has decided the country's first major case on the R&D tax incentive. Importantly, the court has taken a wide view of the activities which satisfy the definition of core R&D activities. Here's the relevant part of the definition. You'll see that it starts by saying core R&D activities are experimental activities. And then it sets out 2 paragraphs, A and B, both of which must be satisfied. The key issue in the case was the significance of the introductory words experimental activities. The court held that those words, experimental activities, do not operate to narrow the types of activities that can qualify. Instead, activities which satisfy both paragraph A and paragraph B qualify as core R&D activities. The court concluded that activities that are conducted for the purpose of generating new knowledge with respect to the application of an existing technology at a new site can qualify as core R&D activities. And the court also expressed the view that a test or trial which is undertaken for the purpose of discovering something unknown or testing a principle can be a core R&D activity. For a copy of this case, please go to our website or app. Also in Australia, the government has released for public comment draft legislation which would impose a cash payment limit of 10,000 Australian dollars, which is about 6,900 US dollars, for payments or a series of payments made or accepted by businesses. It's proposed that the legislation would apply from the 1st of January 2020, although some entities will enjoy a 12 months deferral. Public comments are requested by the 12th of August. For a copy of the relevant documents, please go to our website or app. In India, the Delhi Income Tax Appellate Tribunal has decided a case in regard to insurance proceeds received by a non-resident parent company. The parent company entered into an insurance contract with a non-resident insurance company to insure the value of its 100% shareholding in an Indian subsidiary. Subsequently, the Indian subsidiary lost a significant amount of inventory by fire at its premises. That event caused the value of the parent company's shares to fall, which in turn triggered a payment under the insurance contract between the parent company and the insurance company. The Indian tax authorities claimed that that payment was subject to Indian income tax. They based their claim on three main arguments. The first argument was that the insurance payment was income of the subsidiary because the payment related to the loss of inventory which was owned by the subsidiary. That argument was rejected by the tribunal. The subsidiary was not a party to the insurance contract. The subject of the insurance contract was the parent company's shareholding in the subsidiary, not the subsidiary's inventory. That position was not altered by the fact that the loss of the inventory caused the drop in value of the shares, which triggered the insurance payment. The second argument was that the insurance payment was income derived by the parent company from a deemed source in India under Section 911 of the Indian Income Tax Act. Again, that argument was rejected by the tribunal. In particular, the tribunal said that the insurance payment was not derived by the parent by or through any business connection in India. It was derived from the insurance contract with the non-resident insurance company. And the third argument was that the insurance contract was a colourable scheme or device designed to avoid Indian tax on any insurance payments, and therefore India's common law anti-avoidance doctrine applies. And yes, you guessed it, that argument was also rejected by the tribunal. For a copy of this case, please go to our website or app. Also in India, the Bangalore Income Tax Appellate Tribunal has decided a transfer pricing case in regard to interest paid on compulsorily convertible debentures, CCDs, which are a popular way that non-resident companies finance their Indian subsidiaries. This case is interesting because the tax authorities claimed that the CCDs prior to conversion should be treated for Indian income tax purposes as shares, with the consequence that the payments of interest would be non-deductible. Here's the relevant structure. an Indian subsidiary within a global group issued CCDs to 3 non-resident group companies. Prior to conversion to shares, the CCDs paid interest at the rate of 15% per annum. The Indian tax authorities claimed that the CCDs, prior to conversion, should be treated as shares for Indian income tax purposes based on 2 arguments. Firstly, the Indian subsidiary was thinly capitalised. And secondly, the CCDs were treated as equity by the Reserve Bank of India for the purposes of its foreign direct investment policy. Both of these arguments were rejected by the tribunal. In regard to the thin capitalisation argument, the tribunal simply noted that India does not have any thin capitalisation rules. Now, let me make 2 points in regard to this. Firstly, the facts in this case occurred many years before the commencement of India's GAR provision, and so obviously GAR was not relevant in the case. And secondly, there did not seem to be a well-developed argument by the tax authorities that recharacterisation of the CCDs into shares could be done as an application of the arm's length principle under India's domestic law transfer pricing provisions. And in regard to the argument based on the Reserve Bank's FDI policy, the tribunal stated that the treatment of CCDs under the FDI policy does not determine their treatment under the income tax law. For a copy of this case, please go to our website or app. In Indonesia, the government has published a regulation which will introduce a VAT exemption for the import and supply of certain transportation equipment. The exemption is effective on the 6th of September. For a copy of the regulation, please go to our website or app. In Korea, the government has released its proposed tax law revisions for 2019. A number of items caught my eye. Firstly, the existing tax credit for facility investments to improve productivity will be significantly increased, from 1% to 2% for large conglomerates, from 3% to 5% for medium-sized companies, and from 7% to 10% for SMEs. The existing tax credit for manufacturing facility investments will be extended by 2 years. Also, the number of industries and assets to which the credit applies will be expanded. The existing R&D credit will be expanded to cover foreign research institutes which are commissioned by Korean companies. In regard to the carry forward of tax losses, the current utilisation cap of 60% of current year taxable income will be removed. The government will attempt, yet again, to impose royalty withholding tax on treaty-covered outbound payments for patents which are registered outside Korea but which are used in Korea. You'll remember that the most recent attempt by the government to do this was held by the Korean Supreme Court to be unsuccessful in regard to payments under the Korea-US Treaty. And in regard to tax avoidance, the burden of proving no tax avoidance purpose will shift to the taxpayer if a step transaction results in a 50% or more tax reduction. For a copy of the relevant government documents on the proposed tax revision, please go to our website or app. In Austria, the Supreme Administrative Court has decided a case in regard to the application of the EU Parent Subsidiary Directive to interposed Luxembourg companies. Here's the relevant structure. An Australian fund owned 100% of the shares in a Luxembourg company, Luxco 2. Luxco 2 owned 100% of the shares in another Luxembourg company, Luxco 1. And Luxco 1 owned 39.73% of the shares in an Austrian company, Austria Co. Luxco 1 had no employees or officers. Its only asset was the shares it held in Austria Co. Luxco 2 did have 3 employees, a managing director, an accountant, and an office manager, and it had an office in Luxembourg. Luxco 2 also indirectly held shares in 4 other European companies, all in the infrastructure field. Austria Co paid a dividend to Luxco 1, which claimed that it was exempt from Austrian dividend withholding tax under the EU Parent Subsidiary Directive. The Austrian tax authorities denied that claim on the basis that the interposition of the 2 Luxembourg companies had no commercial purpose and was therefore abusive. However, the court rejected the position of the tax authorities. It held that the interposition of the Luxembourg companies was based on commercial reasons, namely the professional management of the long-term shareholdings in a number of European companies by Luxco 2 via its several employees. The Parent Subsidiary Directive therefore applied to exempt the dividend paid by Austria Co from withholding tax. The European Commission has released its July infringements package. From a tax viewpoint, a number of items are worth noting. In regard to the implementation of ATAD, the Commission has sent a letter of formal notice, the lowest level of infringement, to each of Austria and Ireland, requesting them to implement ATAD's interest limitation rule. And the Commission has sent a reasoned opinion, the second level of infringement, to Denmark for its failure to notify national implementing measures for ATAD's CFC rules. The Commission has sent a letter of formal notice to Germany to recognise the profit and loss transfer agreement concluded with corporations under the laws of another EU EEA member state. And finally, the Commission has sent a reasoned opinion to Greece to align its rules regarding the limited deductibility of foreign losses. For a copy of the July infringements package, please go to our website or app. The European Commission has announced that it has authorised the Netherlands to extend until the 31st of December 2028 3 changes to the Dutch tonnage tax regime in return for a commitment to make some legislative amendments to the tonnage tax regime by the 1st of January 2020. For a copy of the Commission's press release, please go to our website or app. In France, the tax authorities have issued guidance on the operation of the new rules which restrict interest deductions. The new rules transpose the interest restriction in the EU's ATAD and are effective from the 1st of January 2019. For a copy of the guidance, please go to our website or app. In Germany, the Cabinet has approved a bill to amend the real estate transfer tax rules. The bill will now be introduced into Parliament. Under the current law, RET is triggered in a number of situations. Direct transfers of real estate, where 95% or more of the shares in a German real estate owning company are directly or indirectly transferred to a new owner, where 95% or more of such shares are directly or indirectly combined for the first time in the hands of a new shareholder, or where there is a 95% or more change, directly or indirectly, of the partners in a German real estate owning partnership. The bill will make a number of changes, including, firstly, the 95% threshold level will be reduced to 90%. Secondly, and more importantly, a transfer directly or indirectly of 90% or more of the shares in a German real estate owning company to multiple new shareholders within a 10-year period will trigger the tax. This second change has been the subject of public criticism because there's no exception for regular share transfers on a stock exchange. In Moldova, the government has launched a public consultation on proposed corporate income tax law changes. Two of the changes, dealing with capital gains and losses, are interesting. Firstly, under current law, only 20% of a capital gain is subject to tax. Under the proposed change, 100% of a capital gain will be taxable. And secondly, under current law, capital losses can be set off only against capital gains. Under the proposed change, capital losses will be able to be set off against any taxable income. In the Netherlands, the Supreme Court has decided a case in regard to the application of Article 5 and Article 7 of a double tax treaty to a partner in a partnership. Here are the relevant facts. The taxpayer X was resident in Belgium. X was a partner in a Dutch partnership. There was one other partner, Y, who was resident in the Netherlands. The partnership's profit-sharing ratio was 50-50. It was accepted that the two partners were dealing with each other at arm's length. So let's assume that the partnership's profit was $100. Each partner would be entitled to a profit share of $50. The Dutch tax authorities claimed that 50% of X's profit share, in other words $25, was taxable in the Netherlands under domestic law and the Belgium-Netherlands Treaty. That treaty is relevantly the same as the OECD Model Treaty. In regard to PE status, the court held that Y caused X to have a contract concluding agency PE in the Netherlands under Article 5.5 of the treaty. There was no discussion of Article 5.1, possibly because, having concluded that there's a PE under Article 5.5, it was unnecessary to consider Article 5.1. In regard to Article 7, the court held that the tax authority's attribution to the PE of 50% of X's profit share, in other words $25, was not shown to be in error. Interestingly, the court's decision does not indicate why the tax authorities attributed only 50% of X's profit share to the PE. The court's decision does not mention this, but I suspect that X carried on the partnership's business in Belgium. And so the situation might be as shown here. The profit of the partnership is $100. $50 of that profit is derived from the partnership's operations in the Netherlands, which were conducted by Y. And the other $50 of the profit was derived from the partnership's operations in Belgium, which were conducted by X. That would mean that X's profit share of $50 would be attributed 50% to the Netherlands PE and 50% would be derived from Belgium, $25 from each country. It would also mean that Y would likely have a PE in Belgium on the same basis, Article 5.5. $25 of Y's profit share would be attributed to the Belgian PE and $25 would be derived from the Netherlands. For a copy of this case, please go to our website or app. The Netherlands Supreme Court has decided another interesting double tax treaty case. This case concerns PE status under the Korea-Netherlands Treaty. As you would expect, the PE definition is in Article 5. Article 5.1 and the preparatory or auxiliary exceptions are relevantly the same as in the 2014 OECD Model Treaty. In addition, the treaty contains Article 5.2h. The term permanent establishment shall include especially a building site or construction, installation or assembly project, or activities of providing personal services such as supervisory, technical, or any other professional services in connection therewith, where such site, project, or activity exists for more than 6 months. The taxpayer is a Netherlands resident individual who is employed by a Dutch company, ACO, which performs offshore drilling for oil and gas. ACO commissioned a Korean company, BECO, to build a drill ship at a shipyard in Korea. ACO sent the taxpayer to the shipyard as a supervisor for the construction and test runs of the drill ship. The supervisory activities consisted of checking whether the construction complied with the technical requirements. In connection with the supervisory activities, BECO provided the taxpayer with office space. The taxpayer spent less than 183 days in Korea. The issue in the case was whether ACO had a PE in Korea by virtue of the taxpayer's presence and activities there. That issue was relevant to the taxpayer's Dutch tax treatment of his salary for the period he was in Korea. If ACO did have a PE, then Korea would be permitted by Article 16 of the treaty to levy tax on that salary. Article 16 is relevantly the same as Article 15 of the 2014 OECD Model Treaty. And in that case, the Netherlands would be required to exempt the taxpayer's salary under Article 23 of the treaty. The lower court held that ACO did not have an Article 5.1 PE because the taxpayer's activities in Korea were preparatory or auxiliary in character from ACO's perspective. That conclusion was reached on the basis that the supervision activities on the construction of the drill ship were far removed from the profit-generating activities of ACO, and that these activities did not form an essential part of the activities of ACO. The Supreme Court found no error of law in this conclusion of the lower court. In regard to Article 5.2h, the lower court held that that provision was not satisfied, and the Supreme Court again found no error of law in that conclusion. Although not discussed by the Supreme Court, the most obvious reason for that conclusion is that the time test is not satisfied. Article 5.2h requires the supervisory activities to exist for more than 6 months. That was not the case here. In Poland, it looks like the mandatory VAT split payment system for certain B2B transactions will commence on the 1st of November 2019. Voluntary split payments have been available since July 2018. And in the UK, the Supreme Court has decided an interesting VAT case. According to the court, this appeal is concerned with the entitlement of a taxpayer to deduct input VAT and claim repayment of surplus input VAT. It concerns the interpretation of Articles 167 and 168.1 of the EU 2006 VAT Directive and the case law of the European Court of Justice relating to those articles. In short, the question is whether a taxpayer can deduct as input tax VAT which it has incurred in purchasing entitlements to an EU farm subsidy, the single farm payment. The taxpayer has used those entitlements to annual subsidies over several years and intends to use money resulting from the receipt of those subsidies to fund its current and future business activities, which currently involve only taxable supplies. The court held that, yes, the taxpayer can deduct as input tax the VAT which it incurred in purchasing the EU farm subsidies. For a copy of this case, please go to our website or app. In Mauritius, the government has published the 2019 Finance Act, which implements the measures announced in the recent budget. Of particular interest are the new CFC rules and the changes to tax holidays and partial exemption. For a copy of the legislation, please go to our website or app. In Oman, there have been conflicting reports as to whether the scheduled introduction of VAT on the 1st of September 2019 will be delayed to the 1st of January 2021. In a recent bond prospectus, it was stated that VAT is expected to be implemented in 2021. However, the Ministry of Finance has denied that there is any plan to delay the introduction. So far, 3 of the 6 Gulf Cooperation Council countries have introduced VAT: Saudi Arabia, UAE, and Bahrain. Meanwhile, in Saudi Arabia, the government has amended its VAT implementing regulations, effective the 18th of July. 2 changes caught my eye. Firstly, the rules in regard to the zero rating of exported services have been eased. In particular, the previous rule, which requires standard rate VAT to apply to a service which is provided to a non-GCC party, but a benefit is obtained by a GCC party, is changed. Now the rule will be limited to situations where a benefit is directly obtained by a GCC party who is not eligible for a full input tax credit. And secondly, a non-resident taxable person will no longer require a tax representative in Saudi Arabia. However, if a non-resident taxable person decides to not use a tax representative, a financial or bank guarantee will need to be given to the tax authorities. For a copy of the amendments, please go to our website or app. In Brazil, the tax authorities have published a private ruling on the levying of royalty withholding tax on outbound software license payments. According to the ruling, outbound payments for the distribution or commercialization of standardized software qualify as royalties and are therefore subject to 15% royalty withholding tax. For a copy of the ruling, please go to our website or app. In Canada, the government has released for public comment draft legislation on proposed tax measures announced in this year's budget. The draft legislation includes amendments to the transfer pricing rules and to the foreign affiliate anti-dumping rules. Public comments are requested by the 7th of October. For a copy of the relevant documents, please go to our website or app. And now for this week's treaty developments. We've had one protocol signed, one treaty enter into force, and one exchange of notes. I have 3 articles for you this week. The first article is called, "Does the Achmea case prevent the resolution of tax treaty disputes through arbitration?" It's written by Jerome Monsonego and it's published in Kluwer's Intertax Journal. Despite not mentioning this point in the article's title, the article is limited to EU law. The Achmea case was decided by the European Court of Justice in March 2018. The court concluded that an arbitration process under a bilateral investment treaty between EU member states was invalid because no judicial review was possible. The question addressed in the article is whether the same fate awaits arbitration of double tax treaty disputes between EU member states. The author's answer is no. He writes this: "The conclusion from this article is that neither tax treaty arbitration under Article 25.5 of the OECD Model 2017, nor the dispute resolution mechanisms included in the EU Dispute Resolution Directive are incompatible with the Achmea case." The second article is called "Judicial Precedent in the English Legal System." It's written by Malcolm Gammy and it's published in the IBFD's Bulletin for International Taxation. This article is one of a series of articles in the Bulletin dealing with the issue of precedent in regard to court decisions, especially those concerning tax matters. I've selected this article because it provides a good description, particularly for readers from civil law countries, of how the rule of precedent applies in a major, indeed the original, common law country. One of the interesting points made by the author concerns the ability of common law judges to make new law. He points to the fact that for historical and constitutional reasons in the UK, a tax can be imposed only by statute. There is no such thing as a common law tax. Despite that fact, and despite the restrictions imposed by the rule of precedent, UK courts developed the so-called Ramsay principle. He writes, "What is notable is that the House of Lords found no difficulty in adopting an entirely new approach to the construction of tax legislation without any consideration of the constraints that might normally be associated with judicial precedent, or the impact it might have had on the previous decisions of the court." This third article is another in the series of articles in the Bulletin for International Taxation dealing with the rules concerning precedents, especially in tax matters. This third article is called "An Overview of the French Judicial System and the Rule of Stare Decisis." It's written by Emmanuel Courteau-Boucher and, as I said, it's published in the IBFD's Bulletin for International Taxation. This article provides a good description of the way precedent really works in a major civil law country. She writes, "While remaining essentially law-centred, in other words, statute-centred, the French judicial system has made it possible for case law to develop and fill up the areas where no written provision could provide the necessary rules. In any event, even in the fields where case law has gained a special importance, the rule of stare decisis does not apply. As a result, in the French judicial system, precedents are not legally binding, neither horizontally nor vertically. Nonetheless, even though it is clear that precedents are not legally binding, they play a major role in the making of the decisions by judges. With regard to the lower courts, the hierarchy of the judicial system creates a de facto obligation to follow the precedents of the highest courts. The lower courts are not legally bound to apply them, but they know that if they do not, their judgments will be doomed to be quashed when a case comes before the highest courts. Well, that's the way it is this Friday, the 2nd of August 2019. The ITB team will be having a well-earned one-week break. We'll be back full of life on Friday, the 16th of August. Until then, I'm Steve Towers. Have a great weekend.